Thank you for joining us. Thank you for coming to this panel session. I'm Nikou Asgari, Digital Markets Correspondent at the Financial Times. And I'm joined this afternoon by a wonderful panel where we will be discussing the role of crypto in portfolios and strategic crypto asset allocation. So to discuss all of this, I'm joined by Blue Macellari, Head of Digital Asset Strategy at T.Rowe Price, Matt Halstead, Director of Real Estate Investments and Digital Assets at the Teachers Retirement System of Texas, Matt Hougan, Chief Investment Officer at Bitwise, and Sebastian Pedro B, President of Coinbase Asset Management. So thank you all for being here. I guess the first place to start, the first place that I'd like to start, is how you think, sort of broadly, investors should be thinking about and should be considering investing in crypto if they haven't already, or if they are, how they should be considering changing that, obviously with the developments of the Bitcoin ETF approvals, the potential ETF approvals. What does that landscape look like, Sebastian?
Sure. Well, first of all, welcome to the first institutional cycle for digital assets. I mean, look at this room, look at who's here. We are there. We have started the first cycle for digital assets. So when we think about investing, we have to think about that regime that we've just now entered. We're in the first institutional cycle. So that means things are happening, it's time to act, but that doesn't change the rules that many institutional allocators follow. You have an IPS, you have capital market assumptions, you have a strategic asset allocation. You're going to follow those rules, those procedures, which underpin how you invest for your constituents. That's not going to change. But what's next? Well, you've already invested $50-some-odd billion in venture capital. That's happened in crypto already. What's next is probably hedge funds. Bitwise have got a multi-strategy fund. We've just launched our own. And index. These liquid expressions are coming to institutional portfolios because the cycle has started. We've got new laws, we've got regulations, and we have operational excellence with counterparties. So all those risks have receded, and now we're starting to move from illiquid to liquid. I'll leave it to some of the index experts to think about valuation.
Well, we'll get to valuation, but just firstly, broadly, Matt, like what does that landscape look like in terms of investing in crypto, and how has it changed?
Yeah, I absolutely agree with Sebastian. It's changing from a focus on venture capital into liquid assets. I think institutions broadly over-allocated into VC and have very little allocation to liquid, and they're now moving in. I would say the biggest change over the last year is the realization that institutional investors are effectively short crypto because they have zero allocation to a $2.5 trillion asset class. And now they have easy buttons and easy ways to do it. And so people are reckoning with the fact that that is the case. They didn't have to invest in crypto or consider crypto pre-ETF because there were challenges, there was a great deal of regulatory uncertainty. They no longer can do that. And so they're effectively, short this asset that's part of the broad capital markets, and they're trying to catch up.
Mm-hmm. Yeah. And Matt, from your perspective, how are you thinking about crypto investment and crypto asset allocation?
I think the biggest challenge I think we've had, accessing the institutional investor world, is that referring to the universe of assets represented on chain as crypto, I think does us a pretty big disservice. If you think about the variety and the breadth of what you can own with a token or with a digital asset, some of it is venture capital, some of it's a commodity, some of it's art, some of it's pieces of a community. Intellectual property. And so I think probably the biggest thing that needs to be done to make progress and kind of penetrate big sources of capital is to clear up what crypto means. It's really just a format. And tokenization in general is a formatting exercise that is allowing for standardization of how things move around. And part of the big breakthrough of blockchains and crypto in general is really the merging of communications networks and financial networks, and having that be redesigned in real time. And I think if you frame that to a professional investor, it tends to change the conversation. It's not, I don't think it's controversial to anyone to suggest that a portfolio should have exposure to emerging technologies. People have become accustomed to that now for decades in our field. And so I think if people start to understand what specifically you have the ability to own and access via crypto assets or tokens, I think you start to get a lot more curiosity. And so I think all institutions should consider exposure to technology. I don't think that's controversial. And I think that the amount of investments that will be on offer and accessible on chain is going to grow dramatically to, over time, represent almost anything.
And Blue, you might mention curiosity. Where does your curiosity sit in the crypto world? How do you think people should be looking at this?
So I think that one of the things that always surprises me is that when we begin looking at digital assets, most of the time we start with Bitcoin. And in many ways, it's the hardest one to get your mind around from like a traditional portfolio management equity model. So we sort of start with the hardest thing first. And I think that we're seeing very much that the ETFs have brought the discourse more into the mainstream. So this idea that if you're not having a conversation about exposure, you are essentially short the market is very real. And I think that the conversation has become, well, okay, so why aren't we doing this, rather than why should we do this? And that's a much more constructive place to start from.
I want to come on to valuations, which you mentioned, Matt, but also to remind the audience that we will be taking audience questions, so please scan and send in your questions, which I'll ask the panel nearer the end. But on valuations, Matt, how should people tackle this? Let's start with Bitcoin, for example. How do you think about valuations? I mean, there are a lot of models out there, a lot of numbers thrown around, but if an investor is looking at Bitcoin wanting to get exposure, but looking at the volatility, the potential returns, where do they start from?
I think the biggest thing to focus on when you talk to institutions about valuation is not whether it should be 68,000 or 72,000. Right. It's whether it's 70,000 or zero. I think most institutions are worried that zero is a possibility. The way I talk to institutions about Bitcoin is, look, it provides a service. The service Bitcoin provides is the ability to store wealth without relying on a government or a bank in a digital format. If you want that service, you can't pay a fee. You can't pay $10 a month or subscribe to it. You have to own the asset. And from that perspective, valuation is no different than anything else. If you think about Salesforce, it provides a service. If more people want Salesforce's service, the price of Salesforce stock goes up. If fewer people want it, the price goes down. If zero people wanted it, the price goes to zero. The same thing is true of Bitcoin. If more people want this service of storing wealth without a government or a bank, the price will go up. If fewer people want it, the price will go down. If no one wants it, the price will go to zero. But I think you can sort of disarm that argument about whether it's worth zero by framing it as just another service. The unique thing about this service is you can't pay a fee. You have to own the asset. And for me, that sort of solves that existential worry for people, because evidently there are millions of people and millions more each year who want this service. And so we see prices going up. So I think that's more important than the 72, 68, 65. Right. No one cares. If it's not zero, they want an allocation. And I think you can get them past zero with that kind of argument.
Sebastian.
I think when we think about valuation, I think it's great to step back and recognize how emerging this ecosystem is. If we're thinking about the valuation of ETH or Solana or Bitcoin or whatever token and network we want to talk about, then I would ask our panel, and I'd ask all of you, what are the accounting standards that these protocols have to follow so that we can show that all of these things are comparable? And the answer is, there is no standard, right? So let's see, you have still emerging but not final regulation. You have a lack of standards on reporting. How do you compare these assets is not clear. You can't say price to book or price to sales or price to earnings, because all these numbers are very different. So what do we have? We have a very inefficient market, right? This is an early stage market where the fact that you can have an argument with an institution about whether it's worth 0 or 70,000, that's a chasm that doesn't happen except for every now and again on a stock exchange, but that's another topic. It's just a reality that we're very early in this market, so active strategies have a relatively easier bar to get over in terms of a hurdle, because how early the industry is. In 5 to 10 years, when all of this is clear, regulation, reporting standards, et cetera, then it'll probably be harder to eke out excess returns for LPs. But in the near term, it seems like That's something we should also take away. The fact that we have this sort of debate and valuation just tells us how early we are in this asset class.
But do you guys think, is it going to zero the right question? I don't think that's the right question. It's if it happens, how quickly does it happen, and how much liquidity do you have along the way? And so if you were just to take Bitcoin out of it and say, we have this asset, it's a $1 trillion market cap, we have a proxy for where it could be that's 10x that. And we're still not really sure what this asset might do. Like it actually could evolve into have different sources of earnings. It could do different things over time. And if you were to say, I have this asset that's $1 trillion today, you can take allocation to it. By the way, it's liquid. It trades. It actually has depth to the volume that it trades. My downside is I lose 25 cents on the dollar, maybe 50 cents on the dollar if I'm paying attention. I have 10x upside, maybe better, and I can bet that in size. And I think you talk to the people that are the larger investors in the world, you never see that setup. So often, if you have that asymmetry, you have that liquidity, it's a tiny opportunity. Like maybe you could bet a couple $1 million, maybe you could bet 10 million bucks. You can't put a $1 billion plus position on. And I think that's the thing that institutions are going to wake up and look and say, I at least need to understand this better. I need to understand how this fits into my portfolio better. Because if you're right, that is it's a trade that comes along quite infrequently in your career.
I mean, we've got an audience question sort of tangentially along those lines, which says, how do LPs look at the percentage of asset allocation in crypto versus other asset classes, for example, venture capital, PE, credit, and so on? What are those conversations like for you, Matt and Blue?
So it's actually a philosophical question that we've had internally, and this idea that we often refer to, in our sector, we often refer to this 1% allocation, which is sort of arbitrary and doesn't make sense, right? So I also very much look at it as both an asymmetrical trade and as a binary event. So in that sense, does 1% make any sense? Not really. Like, it should be 3. It should be, greater than 1, or it should be 0. And I think that there's a psychological component where people need to test the waters and get comfortable and then sort of move in. I think it's a paradigm shift from the way that we look at a lot of other asset classes, and I think that it takes time for people to sort of ease their way into it.
We were talking outside about investing in crypto as an asset in terms of the token and investing in blockchain, the technology, and companies that are built on that. Do you think it is possible, and have, I guess, the tone of conversations changed in terms of people saying, we will invest in the blockchain companies, but we will not touch crypto itself? Have those sorts of conversations changed, or is that still the way that people are thinking about it?
So the conversations that I've encountered plenty of times are not about investing in blockchain companies. So it's not the idea, we should do VC versus we should do native on-chain tokens. It's the idea that blockchain is a fantastic operational technology that's going to revolutionize everything we do in financial services, and crypto is a Ponzi scheme and not a good idea. And there's some cognitive dissonance there. And I think that one of the things that we've seen over the past few years, I feel like we've seen a lot of movement, growth, development in terms of real-world use cases. And I'm now able to go in and describe something and say, well, there's a technology, and it's going to allow you to execute cross-border payments near instantly at 90% reduction in cost, complete transparency, accountability. It won't get lost in the mail. Doesn't that sound like something we should all stop and do some analysis on? And everyone says yes. And I'm like, well, it's a blockchain. And the way that you get exposure to that is by buying the associated crypto asset. And so I think it's sort of a knee-jerk reaction that you get from people. And I found almost everyone I've ever spoken to about it has been willing to sit down and sort of, once you talk it through, it pretty much resolves itself, I think.
I would just add, who here has not bought a product on Amazon because you're worried about the volatility of the stock or what the PE ratio is? Please raise your hand. Like, have you not bought those shoes that showed up the next day? No, of course not, right? So when we think about the network and the asset, we have to back up and recognize, like, we're treating crypto unfairly, right? Amazon could deliver something, and so you used it, right? And guess what? Amazon stock did pretty well. ETH is delivering something now, and people are using it. What do you think is going to happen to the value, right? We think what's ultimately going to happen here, and I don't know if Samara is still here, I want to agree with her that RWA is a terrible term for what we think are really smart assets. Like, that's what we're in the process of doing. Today, these rails are being cleared. We know it's Bitcoin, it's ETH, it's Base, it's a variety of things. But what we're going to deliver, much like Amazon did, is smart assets. So assets that actually can do more and be more for your portfolio. So when you say, what's the right percentage? I mean, the answer is 100%. Right? Eventually, we are going to, as Blue said, we're going to upgrade the entire financial stack here with these better rails, right? And so today, you can invest in these rails. And tomorrow, we're going to upgrade these assets. We're going to now have smart assets. And then we're going to look back and say, geez, I wish I could have bought those rails before everything flowed on the rails. So yes, 0 is the wrong answer. 1% feels like the wrong answer for the native crypto assets. And if we're going to upgrade all of the assets to be smart assets longer term, then I agree with Blue, it has to be more than 1 or 2.
I just toss in a few fun anecdotes from Bitwise. You know, we do 20,000 meetings a year with investment professionals around crypto, financial advisors, institutions, family offices, and we have a suite of decks that we can choose from and slides we can choose from to have those discussions. I will say that I have not used the crypto not blockchain slides in our deck in 4 years, and 4 years ago they were maybe the most common slides that we use. So I do think that conversation has changed. The other anecdote from our slide consolidation is we used to talk a lot about 1%, and now, based on what we're seeing in clients, we talk a lot more about 2.5% and 5%. So just some data from Bitwise's unique experience.
And that's in liquid strategies, right?
Yeah, liquid allocations, yeah.
So, I mean, I'm interested in, as someone in the audience, about how you think about, or how investors should think about liquid investment compared to, VC investment and compared to equity stakes, for example. And I know we've sort of touched on that briefly, but I guess, is it more of a challenge to sell the liquid token investment to investment committees?
So I think that very much depends on who you're talking to and what their sort of focus and objectives are. So from the T.Rowe perspective, for us to have an asset class perspective on digital assets, it was absolutely critical that we have experience trading end-to-end natively on-chain, right? It's an operational technology. These assets move differently. They settle differently. AML KYC is different. You're not using the same OMS, PMS, any of these systems. And so for us, it was being natively on-chain trading from start to finish, which I think is very similar to probably what most of our personal experience has been, which is crypto is learning by doing. And so for us, that was very, very important at the institutional level. But I think that there are a lot of circumstances in which the versatility of the ETFs, the format is, especially if you have a large established back-end middle office, the ETFs are like plug and play. They work with everything. You don't have to build anything new. You can include them in other financial products. It's the ease of use, I think, has just been astounding, and I think that's been one of the drivers of this success.
Yeah, in my experience, it's been more difficult because tokens are conflated with cryptocurrencies, which is conflated with Bitcoin, and that traditionally has been this macro conversation that people have been uncomfortable with, because the branding and just kind of the broad coverage of the industry is just generally really bad from mainstream channels where people are consuming their information. And I think one of the biggest challenges is most large traditional institutions work with buckets that are an artifact of the consulting industry and benchmarks and things that were completely appropriate for asset allocation and portfolio construction, but really haven't adapted or changed or evolved. And I think one of the biggest things that I've realized is that this is disruptive technology to the investment management business itself. So like classic innovator's dilemma, folks are trying to treat this like a sustaining technology and plug it into portfolios that make this asset, it gives them the wrong signals. So an example of it in the liquid market would be our public equity portfolio should have this token exposure because these are tradable assets on a public market. But what is a crypto asset? Like I said at the beginning, it represents all these different things, but most of them tend to skew towards early stage venture capital risk. And if you benchmark that against the S&P 500, it gives you the wrong signal. And so what that's resulted in is a lot of challenges from early adopters within investment firms advocating for liquid strategies, as they should, because liquidity is it's a feature, not a bug of investing. And over time, I think these portfolios will change and will adapt. But the compromise that I've had to make is just let's put it in a traditional venture capital closed-end fund wrapper. People are more comfortable with that. It allows us to wear and survive the volatility in the industry. And I just think that it will take time for the market to gradually evolve. And it will likely result in a lot of the legacy participants going out of business and new firms being built that fully embrace the way that the world is changing. And I think most venture funds will look more like hedge funds and not the other way around over time.
Yeah, Matt, you want to?
Yeah, I would just add two things. I mean, obviously, if you had a clear choice, liquid or illiquid, liquidity is a feature, as you said, particularly in a volatile asset where you can volatility harvest. You don't actually need Bitcoin to go up to make it a valuable part of a portfolio. It can go sideways or down if you harvest the volatility and still increase your risk-adjusted returns. I think it is true that many people started with venture basically because of career risk, or if you're being more charitable, because they didn't know how to do diligence crypto native exposures. I do think there's a movement to multi-strat funds because people are moving up the chain of comfort on their diligence factor. But I think it's probably incumbent in what we're going to see is the illiquid side start to deliver different types of returns from the liquid side. I think for the last generation, you've seen illiquid funds delivering liquid-like returns, and that's probably not good enough now. I think multi-strat funds and other funds are going to have to deliver different pattern of returns, and I think that's what you're going to see for the next few years.
I mean, I think people understand that it takes time to make something bigger in a portfolio, and it really takes time to go from 0 to 1, right? That's really the problem that most allocators are suffering with. And and I think we also have to recognize there was a bit of a stop-start that we had last cycle that people are still kind of licking their wounds from. And they're looking at this current change, and we're all saying, well, is it for real? Like, is it really real this time, right? And I think that's we're all feeling that hesitancy because it was wonderful to hear Brian talk about the Senate working on multiple bills to bring crypto potentially into the regulatory mainstream this year in the United States. I can tell you for sure on our desk a month and a half ago, that was not the expectation. So I think if we, who are doing this every day, are still kind of basically having recency bias, where we're stuck saying, is this really happening? It just feels too good to be true. Think about then what it takes for that. We really need to kind of believe it and then see that progress happen, because I think people are also gun shy on the margin from what happened a couple of years ago, where every major pension fund had a digital asset working group, and they all called them dogs, right? and we were all geared up to do things. And a few instances they did do things, and it did not go terribly well. So this is our second chance as an industry. We have to do it right. I think it is being done right, but I think it's going to take a little bit more time for the all clear for some institutions, but not much more. I mean, we're really knocking on the door. If you think about end of year planning cycles, who is going to go away for the summer, come back and say, okay, we're not going to do something in crypto in 2025? Like 0%, right? Everybody's going to get off the beach to do something. And there, in many cases, to borrow a phrase, the hay's in the barn. You did work for 2 years, and then Luna blew up, and then FTX blew up. You'll come back and say, okay, a lot of that research was quite good. And now what has transpired? It's all gotten better, right? And that's going to make it a lot easier to make this transition from illiquid to liquid. And I think we're going to see it over the next 6 months.
Just on your point around the blow-ups of recent years, what lessons do you think have been learned around that? Or yeah, what harsh lessons, I suppose, have been learned around that?
I mean, I think the harshest lesson everyone learned was that FOMO kills quickly, right? The rush to do anything is always a bad idea, right? It's fantastic to see this sort of event happening, and there's a lot of enthusiasm here. But the thing that's most bullish is that we are all tempered in our excitement, right? We are still talking about some of the frustrations and around kind of moving this forward within our own organizations, not so much at Coinbase, of course, but in general at allocation houses. And so I think it's just going to take a little bit more time to get through the memory of before. And people are going to move, I think, more decisively, but they're not going to be moving in big, audacious chunks, right? $100+ tickets into individual companies, which is what happened last cycle in certain instances. I don't think that's going to happen again, right? I think people are going to rely on their GPs and to be a little bit more risk averse as they push more consistently forward.
And you mentioned some of the frustrations, not at Coinbase, you say, but otherwise. I'm interested, Blue, in what challenges you face when it comes to pitching crypto investments internally in a sort of quote-unquote traditional financial institution, right? What are those conversations like?
So I think that we still have a portion of people who will say, well, it's a Ponzi scheme or it's used for illicit activities. I personally think it can't be both of those things. You kind of have to pick one or the other. They're mutually exclusive. But and then beyond that, I think we now have people who are looking at it and asking, well, there's no cash flow. How do I put this into my traditional framework of where I sit on the asset class spectrum? And I think that becomes a challenge. And there are, issues that arise in a multi-asset viewpoint, issues that arise in an equity viewpoint, primarily around cash flows. If you are a passive holder versus staking, what does participation look like, and how do you model that? And I think it's a lot about education, and it's a lot about sitting down and saying, we shouldn't be taking our existing models and copy-pasting them on top of this. It's not going to work. And it's an educational process that you work through. And I can say that, the morning after we got back from Thanksgiving, I sat in a very large meeting, and, right after FTX blew up, and 3 different people in the room said, so this is the end of crypto, right? And I was like, well, Soros, did we all sit around and say, is that the end of the pound? Like, no, that's not how this works. And I think that we've had a lot of ground to cover, but I actually think it's been a really healthy set of developments for the industry as a whole. I think people are much more conscious of leverage, much more conscious of the interconnectivity around how we use credit. So I actually think it's helped the industry mature in a way that was really critical to bring us into this cycle.
Matt, what about you? What sort of conversations and challenges do you perhaps face pitching this internally? Is it the same as Blue?
Oh, man. Trying to help people envision investing in something because it's plausible, not because it's likely, it's very hard to do. And in general, at large traditional institutions, it's much more of an agency mindset than a principal mindset. And that is reflected in risk aversion. And I think early, a lot of what I tried to do was inspire, like to say, hey, can you envision the way this world is going to change? And if so, how might we invest in that? And how might that lead to extraordinary returns for our members? And I think in general, that approach is ineffective. And I think when you understand the goals and the motivations of the individual you're speaking to and the organization you're speaking to, it makes more sense. And so I think it's more, if you were to go now, what does the downside look like? And why can you get the security in your mind that this isn't going to be a bad outcome for you, and set you back more broadly? Because you have to understand, like, the goals of these organizations are broad and they're vast, and the trade-offs that might be made even if the returns are compelling, could be unacceptable because it could be a catastrophic setback elsewhere. And I just think understanding that is the key to everything. And then making something abstract relatable. I think being a student of history is probably the most helpful tactic that I've found to get people to move forward. And making it relatable and helping understand, like, throughout human history, even professionals have been really bad at visualizing and projecting what transformative technology might look through. When you start talking about blockchains and AIs, like, I believe crypto is being built for its robot market participants and AI agents. Like, this whole idea about people using crypto in general is missing the point. And that we are having to rebuild this system from scratch to, like, visualize what a future world might look like that we've never seen in history. And so that challenge is, it's remarkably difficult. And so I think a lot of it is, just trying to use analogies and really mitigating downside through bet sizing and positioning. Because I don't think there's no way to force this. And I think the general investment management business has largely been built around fees, which is don't get fired is the mindset. And that culture permeates the industry. And so there's a lot of people that said, advance this idea further and I'll pay you 10 times more. And that is the culture of large-scale professional investing today.
Sebastian, what do you make of that?
I was just going to say, I think what our allocator clients need is more tangible use cases that they can see make a difference in the markets in which they already operate. And what's phenomenal about crypto is we've created some great use cases, store value and payments. But a lot of those two things are really helpful for people that are mostly not in this room, right? They're transformational in emerging markets, and there's been discussion of it. What we're starting to see is the evidence that these rails, right, are creating differences in traditional markets. They're actually disrupting real-world activities. So, for example, figure lending is now the #1 non-bank HELOC issuer in the United States. So from issuance to securitization, they're saving about 100 basis points, give or take, versus traditional processes. I think the #1 game in asset management is not to sell the product, it's to sell the outcome. And I think we can all get on board with an outcome like that they're using, in their case, provenance, but they're using a blockchain to create a better financial outcome for the investor that buys the production and for the borrower who's borrowing the money. Neither side is, to Matt's point, touching crypto, right? To them, it's just working in their existing flows. But figure lending is owning that in between. That's an example that, as it becomes more apparent to people, you're going to see more of those things. And then I think it becomes a much easier conversation to the end of this year, because they'll say, oh, yeah, I got my HELOC off of Figure. What blockchain are they using? And then they'll understand that, that now a smart asset is occurring. In this case, it's a HELOC, but smart assets are being created, and now these rails are really valuable. We're very close to that point.
We're running out of time, but the last question is an audience question that I want a snap answer each, please. And I think, Sebastian, you sort of already answered it. The question is, what percentage of institutional portfolio assets will ride crypto rails in 5 years? And I think you said 100% earlier,
100%.
right? Yeah. Matt?
It's, at least in certain markets, I think we're going to get to 100%.
Yeah, I think that's exactly right. I just agree.
Matt?
5 years?
5 years.
Oh, 5 years.
Very low. Very, very low amount. I would agree the end state, 100%
Okay.
or close to it. 5 years, less than 5%.
Okay.
Yeah. I want to make clear I didn't understand the terms of the question.
5 years.
Yeah, I'm 100% eventually, and slightly more than 5% in 5 years. I do think it's a longer-term story.
Okay. And Blue, finally.
I'm along the same lines, 100% ultimately single digits 5 years out. But I think there will be jurisdictions that get to 80% plus in 5 years. I think Brazil gets there. I think Argentina may get there. So I think that there are going to be jurisdictions that make the move wholesale in a way that really shows us what can happen.
Optimistic note to end it on. So thank you so much. That's the end of our panels. That's the end of our time. So thank you so much to our panelists.